Hello everyone, today is Friday, August 12th, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, episode 644, where it is our job to break down the most important trends, price action, noteworthy moves across financial markets that you may have missed. Now, if you're brand new to this video series, here's how these videos work. We break up our analysis into two parts. So in part one, we comb through the numbers, we pick apart everything that stands out or looks different. And then in part two, we jump into the charts, we take a very close look at price action, measure and map some key levels, and then look at the broader trends to help position ourselves looking ahead. So hopefully that sounds good to you. Let's jump into this very bullish, exciting week here for the markets. We had the CPI index. So this was sort of the tail of this week, I believe, both to the bad side initially, and then the catalyzing sort of force to really kind of push this market up. We had the CPI index decelerate, come in above expectations or lower than expected numbers at 8.5% year over year. I believe last month in June, we had a 9.1% reading. So the market is at least interpreting this as to be a good event, that perhaps inflation is contained here. At least that is the hope of the bull case. We have the stock market basically in full-on chase FOMO mode right now. If you want to participate in this market, it is very tough to get involved because we're just not getting that pullback and the market is sort of steamrolling higher. Meanwhile, we do have interest rates creeping higher. And those 10s-2 spreads we looked at last week, those still look pretty ugly right now in terms of recession indicator or anything else you want to glean from that. And in this video, we are going to look at some previous bear market rallies and just the magnitude of kind of where we are versus prior history. We're also going to be looking at a market direction indicator that is starting to flip. And we're also going to dig into some sector internals. Those are all later on in this video. So let's jump right in here. The numbers on the right-hand column, that's the 1 week numbers. We had, again, just a very uniform, strong rally across the board, basically 3 to 5% here for the US markets. The Russell 2000 notably here up almost 5% now, and it's up 15% over the past 1 month. So it is very much coming into sort of leadership territory here, really just marching higher, kind of bringing everything else with it. But notice everything here is now over double digits over the past month in terms of US stock market gains. Now, if we look at these trends here, this is nothing new. The 10 and 50 SMA have been rising now for a couple of weeks in these indices here. Notice we still have the 200 SMA declining. It's going to take some more time and mostly time, but certainly holding above at these prices would be a benefit as well. But we got to get a little bit higher, a little bit longer to start moving this long-term trend. But clearly the very short-term and intermediate term here are still pointing up. Now, if we take a look at the volatility environment, the big story here is that we've got the VIX index. Volatility index is back to being a teenager. It is below 20, and this is now multi-month lows here. I don't think it is year-to-date lows yet, but it is certainly a good sign here that we are getting price advancing to the upside. We're getting volatility that is being sucked out of this market. This has been a very strong trend. I mean, if you followed the VIX here, it has been telling the story over the past few months, frankly, about 6 weeks or so. Not to say that it was an easy or a foolproof signal, but it has certainly been accurate here in the fact that the VIX has been heavy now for quite some time, and this market continues to ratchet higher. A Nasdaq vol here is at 25, so once again seeing much more improvement there, and comfortably below that very kind of stiff 30 level that it was at for quite some time. Now, if we take a look at market internals here, the NYSE 52-week highs and lows, we are getting some improvement here as well. So remember, this is sort of the stats that we've been kind of waiting on in terms of getting more highs made in this market, getting more stocks kind of breaking out to 52-week highs. And it's been slow, but we're starting to finally now get these numbers increasing a bit here. You can see see double digits on the number of highs made all week. No triple digits yet, but notice on the aggregate, in aggregate here on the week, we finally are starting to see more consistently more consistent stocks making 52-week highs versus those making lows. That is good. That is what we want to see here. And if we look at this chart of basically those numbers over the past 30 days, if we're just looking at the net numbers of highs minus lows, you can finally start to see that this trend is starting to go sideways here, and it's just beginning to start inching up right now. This is, sort of reminds me of, a big battleship, a Titanic, right? That's starting to finally change directions. Very, very slow, this measure of market internals when you're looking at 52-week highs and lows. And you're getting that just very slow, gradual kind of turn in the market here. This is good. I mean, we want to see this start getting up. We want to see this trend, consistently start moving up, which shows that there's expansion in the number of stocks making 52-week highs. We're not quite there yet, but it has been improving. Now, here is a chart from Charlie Bolello. I feel like I've been stealing his charts almost every week, but he's got some good analysis here and some good research that he does. So check him out, Charlie Bolello on Twitter. These are his charts, not mine. And he's got two charts printed here. If we look at the top one first, this is the 2000 to 2002 sort of bear market. And all of these, green sort of framing outs here of price action, these are the sort of bear market bounces. These are the, trough to sort of local peaks here in price advancing. And so you can see that we had, a 19.3% bear market, which then, ultimately failed, rolled over, and made new lows. We had 21% rally here, kind of took some time, 8.5% rally in between, and then rolled over. Then we had a 21%, then rolled over. And so the point that he's making here is that, a 15-20% rally in the market is still potentially in a bear market, right? That can still keep us in a bear market. And that means prices can still, ultimately trend lower. And if we look at bottom left here, the current bounce in the S&P 500 is about 17.5%, just to give you some historical context here. If we look at this bottom chart, you can see this is the 2007 to 2009 bear market. You can see once again, you've got 13%, 8%, 18.8%, 24%. All of these bear market rallies, all of these rallies had lower lows to come afterwards. So again, not a guarantee, just providing context here that a 17.5 bounce could still keep us in a uncertain, sort of more macro tough environment for longer. Now, let's go the other way. If we take a look at sector performance here, we've got green across the board. Beautiful week. If you're looking at just general participation, we had energy bouncing back sharp, financials and materials, very sort of, kind of real world, inflation sort of driven rally here. On the downside, we had consumer staples, healthcare, and technology were the bottom three or underperformers this week, 1 to 2% higher. Notice the 1 month numbers now, everything is in the green, and even the 1 year numbers, we're starting to get some more improvement here in some of those individual sectors. Now, correlations really haven't changed here, so this is kind of been pretty steady. We've got lots of correlation going on between the averages, the US indices here, and even world indices. And then you're still getting a pretty good strong inverse correlation to what the dollar is doing. And it's weakened, perhaps a little bit here, but still minus 0.46 or so is still pretty tightly correlated. Then you get interest rates in there, you get the long bond TLT inversely correlated as well. Now, the sort of unfortunate story for this week is that Treasury yields are starting to inch back up, and this is something again we'll have to keep our eye on if we think about catalysts or potential pitfalls in this rally. We have to look at interest rates, and if this starts to really ratchet back up, ultimately the market is probably not going to be too happy with that. And so right now, get the 10-year yield back over to about 2.85%. Remember, just a couple weeks ago, it was knocking on 2.7% on the downside, trying to make new multi-month lows. And so it is definitely continuing to rebound. Now, finally, if we look at the dollar and commodity performance this week, we can see we've got natural gas at the top of the list. This is back to almost a 10% gain on the week. We had crude oil marching higher here. I think it was still an inside week for crude oil, but almost 5% higher. Silver, very strong. Bitcoin and agriculture, gold, everything basically rallying this week as the dollar continues to fall. All right, and that brings us to the end of our free edition of Stock Market Weekly. If you do want to continue on, we're going to dive into a lot of price action analysis right now. We've got some sector internals we're going to be looking at and a couple of other indicators that are starting to show us some different things. So if you do want to continue on for the extended version, another 10-15 minutes of analysis, then definitely check out thetraderist.com/SMW. If you're not already there, you can buy this episode for $5 if you just want to catch this remaining episode, or you can subscribe monthly for $15 and you can get every single extended version from here on out. So we would love to have you as subscribers. Check out the link there for more information. Otherwise, thank you so much for tuning in to our free edition, and we hope you have a great weekend. Take care.